Doing this conversation on this topic uh, would have been very easy in Bombay in front of a public market audience. But doing this in Bangalore in front of an entrepreneur VCP kind of audience is very tricky. It feels like I'm going to walk into the tiger's den right there. So I will tread it cautiously. So there is a feeling, obviously, in the public markets that over the last 1.5 years, there was, of course, a lot of optimism and a bit of exuberance in the air. And there was a mismatch of, in terms of expectation and reality between public and private markets, which meant that there was a lot of value erosion that happened in public markets. So there are two ways to look at this. One is there a mismatch between the private market reality versus the public market expectation? Or is there a mismatch between private market expectation versus the public market reality? So you can frame it either ways. Nevertheless, there is a sort of a gap, and if you're able to bridge that to some extent, everybody will have a happy experience. So let me start with Mohit first, because you have more than 200, 250 odd investments in your portfolio right now, have been investing for a very long time, have had, at least amid this panel, a large number of your portfolio companies go public. What's going wrong? Why this disconnect at all, in your perception?
Well, thanks for having us here today. And just to correct you, that investment portfolio is over 400 companies, and that combines everybody from seed to companies that are ready to go public. I think I would not put the spin off what's going wrong. I would almost say this is a maturity cycle. I've been doing this for 17 years, and the initial question used to be asked of us, which is, where are the exits? Where are the exits from the startup ecosystem? And I think the right question to ask is, where are the scale companies? And if you just count the number of startups that have now crossed over $100 million of net revenue, not GMV, not some vanity metric, but real revenue, that number is accelerating. And as the companies get to that size and scale, they now get to the point where they can actually approach the public markets. And so we think it's a maturity cycle whose time has come. There used to be this very large overhang saying, look, if you're a tech company and you're investing in the future and you're not profitable, you're not going to be able to go public in India. Well, in 21, with Zomato and a bunch of other folks who went out there, they went out and have opened up in many ways an opportunity for the next wave, which we think is going to happen starting end of this year and next. Now, have we all learned some lessons as to how we need to guide better on paths to profitability? Absolutely. I feel like it's the stepping stone for the next set of entrepreneurs who will come in there, do better guidance, understand the importance of showing that path to profitability while they keep investing in India's future. So to me, it's a maturity cycle, and we're actually quite glad when we are asked by our founders, should we go public in the US or should we go public in India? It's an easy answer. We should try and go public in India, because I think this market is ready to see a lot more of our tech startups.
Sure. Abhay, do you have a different take?
It's not a different take. I think the public and private market investors think differently about businesses. As private market investors, especially early stage investors, you have to be a little more optimistic. You have to chase higher growth. Mohit and I have been doing this for a long time. And the funny thing is, between 2006-07 until 2019, all our public market friends, and we have a lot of friends in the public markets, including investment bankers, mutual fund managers, and so on and so forth, they'd always keep telling us, what are you smoking? Because we'd say, oh, this company is so valuable, this company is doing really well. What do you mean by really well? Oh, they've got so much of GMV or revenues with very low margins, etc., etc. It flipped in 2020. We started asking our public market friends, what are you smoking? Because we saw some value. They started seeing greater value in those companies. And we could not understand as to why they were seeing so much value in those companies. And they wanted more and more of it. And then I think starting second half of 2022, we're both getting aligned. I don't think the private market investors are thinking very differently on what the expectations of the public markets are. That's reasonably well understood. The private market investors now know that the companies coming from the private markets will have certain characteristics, but they should not start expecting the moon again from them. They'll have a certain curve, certain trajectory, and how to value them and how to treat them, etc. So I think we are in a much nicer phase today where both the public and private market expectations of what these companies should deliver, what should the trajectory be, are getting aligned. And the best outcome of all of this is that founders are now getting to understand that this is what the destination is. When we all talk about enduring companies, everybody has to know that you have to self-sustain at some point in time. And there are certain metrics that people say so much of EBITDA and so much of revenues to go public and so on and so forth. But those we can debate on. But the path, the direction, the trends is something that we all agree on. And it's the responsibility of the private investors to make sure that they're guiding their founders early on that direction, maybe with a 10-year horizon, but at least start talking to them early on versus take them the wrong path of saying, hey, get a lot of revenues, take stuff A from one person, give it to another person at 3% gross margins. That will never make it. And that we have understood, the founders have understood it, and public markets always knew it.
Sure. Sure. So, Salil, are you seeing what Abhay is pointing out, that there is this gap between private and public market expectation that is getting aligned? Are you seeing that in the conversations that you have with, exiting investors or promoters who come to you with the IPO mandate?
So I think the first point that I'd like to say out here is we can always beat ourselves to say, okay, there was a mismatch of expectations between what private markets were thinking and what public markets have been looking at. But we've also got to look the positive aspect that, while there have been a clutch of companies which went public in the new age businesses, and some of them have underperformed in terms of the stock pricing, but the fact is they got capital, and they got capital from public market investors at a time when their business and the valuation metrics were what they were. But you still got access to public market money, which means that public markets are receptive to businesses and business models. But not everyone who reached out to public markets got the interest from investors. So which means that people in the public markets have been very selective about what they want to look at. They are willing to take some extra risk, which means that even if I'm not making money as a company today, when I go and hit the markets, it's not that the public markets have been shut, and even today they are not shut. But when you hit the markets on the public side, as a company, am I sizable enough? Do I have some moats which make me a differentiator? Do I have a business model which is a little, the longevity of it can be, you can thump the table and say, oh, this is going to last for a very long time. Because mind you, public money is money for eternity. It's not money for 3 years or 5 years. So moats, long-term business model, ideally profitable. If it is not profitable, at least if there is a very visible path to profitability. Even if the margins are low, if the margins eventually can scale up because size and scale and therefore operating leverage comes in. If all of these characteristics are seen, public markets have been receptive to taking risks. And I think this takeaway we are now seeing incrementally when we talk to promoters, founders, and private equity investors of companies who are wanting to potentially look at the markets. They're completely cognizant of the fact that if some of these characteristics are in play, then it's worth attempting going to the markets. But if some of these are not, and if it is like Abhay was also saying, it's only GMV and the likes, then the markets have anyway given the verdict that those businesses are not easily going to be welcome.
So are the private markets also receptive to this idea that you have to have these 1, 2, 3, 4 things in place versus growth or profitability metrics, etc., to be able to go out and do an IPO? The fact that you need to offer a happy experience for the public shareholders, is that sort of, do you see that being part of the conversation now?
I think
because at least I understand from a lot of investment bankers last year that there's so much pressure from investors, from promoters, and not budging on prices, etc. Is that conversation changing?
I would think so. So when the public market bankers, we found situations wherein late stage private equity was, for some time during the period of euphoria, was somehow mirroring the venture way of valuing businesses. Okay, which is whatever you say, price to GMV and the likes and whatever. So this was for a period of time that was existent, and as public market bankers, we were finding it difficult to relate to that. I think right now what we are seeing in incremental investment of late stage private equity, that is mirroring what I talked about, of a mindset of, is there profitability, is there reasonable visibility of profitability, and I'll value businesses keeping that in mind. So which means that the value metric changes from price to GMV or price to sales to a price to earnings. Earnings could be EBITDA, could be PAT. We're seeing a lot more EBITDA based stuff. Willing to look at EBITDA 2-3 years down the line, but after having understood that, okay, there is a chance that this kind of EBITDA will get delivered. So this valuation thought process of late stage private equity, which was biased towards venture, seems to be now going back towards bias towards public, which is great news.
Sure. Devina?
What is your question, or you just want me to?
Yeah. So
Okay. So as far as these ventures going public, if I go back to the boom time, which was 2021, and I remember Mahalakshmi, the 2021 Diwali special when we spoke about it.
Absolutely.
And my takes even at that time were two, and which hasn't really changed. One, of course, the point that you made, that good that Indian companies, even without profitability for the first time, could access the Indian public markets. So that was the good thing. But I was also equally clear that the valuations and the way the issues were being done did not make sense. In fact, I remember a TV interview where the editor of the channel said, Devina, if I put a gun to your head, which one of these IPOs would you buy? And I said, even gun to my head, I won't buy a single one, because none of them make sense at these numbers. So they were like, of course, there were many issues that I had, and one of them was this, that almost all of them were going public at 2-3 times the last raise, which may have been as late as just 3 or 6 months before the IPO. So I found that, I mean, it's, again, as Mahalakshmi said, dangerous saying it in this to this audience, but I found that the private investors were pricing it to perfection, and then taking a multiple of that to the IPO market. You are essentially treating, I mean, it doesn't sound good, but essentially treating the public investor as the greater fool. And that's how it panned out. Good that there are lessons learned. I hope there are lessons learned, and that would not be repeated, because ultimately, if the public investor does not have a good experience in the markets, then they don't come back, at least don't come back for a while for those sort of companies. So if you want that market to last long, you cannot kill the golden goose. I mean, on an aggregate basis. It worked out fine for the companies which did manage to raise the money. But on an aggregate basis, that means that you're scaring away investors. And the other thing which I would like the private investors to keep in mind also is that the investor on the street treats the names of the funds who have invested as like kind of a good housekeeping seal of approval. So you are assuming that due diligence has been done, and no scams would come out, and or not necessarily in the public markets, but there have been large ventures which you are all aware of, where there have been big scandals, and where even as an outsider, as somebody who's never met those companies, just looking at public information, it was clear for months or quarters or sometimes even years that something very strange was going on, and yet the rounds of funding kept going on. And as I said, that for the people at large, they think that so-and-so fund has invested, so they must know everything about that. The corporate governance would be great. The accounting will be perfect. So that's the responsibility of the private fund investors, to make sure that is actually the case, and the public can trust this, because as I said, that for this business to go on, the public has to be able to trust. And that is important. You cannot look at, I mean, up to a point you can look into the future, but they were at that IPO boom time. I saw reports saying that 2035 profit will be so much, or 2040 profits would be so much. And that path is never clear. And having done public markets for a long, long time, let me just give one little bit of information that of the 4,000 listed companies in India for the last 10 years, if you look at how many have shown some profit growth every year, a bar as low as that, just G greater than 0 every year. Guess out of 4,000 companies, how many there are? Just 10 years, not even very, very long. Only 17 companies. So, making a Excel spreadsheet and dragging the growth rate is very easy. So always also look at the downside, look at the risks, what can go wrong, and don't price everything to perfection. That would be my advice.
Sure. So two or three important points you've brought up, Devina. One is, I think the disconnect, of course, valuation is the bigger thing because it's really in the face, but there are two or three things that are underlying these valuations. One is this, the matrix of growth versus profitability. And if you see some of the companies that have now in the public markets have charted a path to profitability, the moment you see them moving towards profitability, the growth is really coming off. You look at Zomato, one of your portfolio companies in the food delivery business. I mean, they're actually pulling back from several cities. So two things. One is, is there an exaggerated view of the total addressable market that the private market has been taking, which is, setting up the whole segment for disappointment. And I think Nitin is not here, but Nitin had also talked about, the total addressable market issue sometime back. He had tweeted about it. That's one question. And of course, there is corporate governance, etc. We can take that. But is there an exaggeration of total addressable market, and are we aligning to a different sort of a paradigm now? And second, this matrix between growth and profitability, before the IPO stage, like you said, in the late stages, is that already being set as benchmarks so that you prepare the company well in advance for a happy experience at the IPO stage?
Can I just add a little bit to what you said, which was my concern even at the time of that IPO boom. As I said, there were several concerns, and one of them was that if you looked at the trajectory of almost all the companies, whether Policy Bazaar, Paytm, Zomato, etc., most of them had cut back on marketing spend and were showing declines in either growth or market share because you want that path to profitability, or at least lower losses as you go into the IPO. So there's an inherent conflict in the way you were doing business and how you want to present to the public markets, which look at quarterly earnings. Please.
Yeah. No, I think put yourself in the shoes of a private market founder who's looking to address the public markets in a couple of years out, right? What are the learnings that he or she have got? First is, I can go public. There is, what are the pros and cons of it? Why am I going public in the first place? Investors understand if you price it to perfection, is likely to have very little liquidity post going public. So what is the whole purpose? It's not like you're going to get an exit if you really haven't got a very liquid stock. So you got to price it right. Second is, if I go out there and then I actually end up with a crash in my own stock, guess who's the biggest one who suffers? It's me dealing with my employee concerns. It's me being able to answer that back to the street. So there's no real fun versus being a private company where you're not that answerable on a daily basis to anyone else. And so now you really come back as a founder and say, why am I going public in the first place? Like, what is the benefit for me, right? And it's for founders, it's for different reasons. Some of them want to leave a legacy. Some of them want to create a public company, run a public company, and have an enduring business built out. Others think it's a great marketing event in order for them to be taken more seriously in terms of if they're a B2B company. For example, Freshworks, one of the reasons they went public was they just build their awareness for their brand with their potential customers in the enterprise class. But once a founder decides to go public, it's not like they're not learning from all of the stuff that we're discussing here. They need to understand that their business models are intact, the moats are up. They may need to make sure that if they're not profitable today, they get this healthy balance between, call it a 25, 30% growth, but it comes with a profitable business model. If I'm now choosing to still invest for higher growth, it better be in parts of the business. If you look at Zomato, how they look at a sum of parts with Blinkit and Zomato being very different. So I think these founders are very sharp and smart and nimble and are learning and listening to all of these things that are being said on forums like this. And that's where I started off. I feel like this is a maturation of our entire founder ecosystem and all of us as investors as well. This next wave of companies that go public will learn, will be standing on the sort of shoulders of everything that happened before them. I don't think you're going to see some of the, call it the rookie mistakes that are being pointed out here.
Sure. Abhay, now, all of us know there is a funding winter and valuations are getting marked down and all of that. And today morning, I think Vinod Khosla also talked about, capital efficiency becoming, taking center stage because now capital is scarce and therefore, how do you build your business in less capital will also be important. Does this change the dynamic significantly in terms of valuation also? Because we saw even in issues like Nykaa, which was very capital efficient, the market was so exuberant at that point in time that it didn't really matter. So how does this funding winter really change the scenario for public markets? You can take that question.
Yeah, but I think it's overall a very, very good learning time for all venture investors and all private market entrepreneurs. At least at A91, we've taken a slightly different view than the venture market in India, which I think in general was trying to, or has been trying to compete with the US market or the China market in terms of outcomes. Our belief has been that given the Indian market is very open, i.e. the best tech companies in India are Google and Facebook and Amazon and Microsoft and so on, we are unlikely for a very long period of time see the $50 billion company and the $100 billion company and so on and so forth. What it means is the best Indian companies in the private markets, because you're playing in certain niches, certain verticals, and so on and so forth, will be between $5 and $10 billion of outcome in the medium term. We may have priced some companies already at much higher numbers, and we are wrong. The real valuations of those companies are much lower, and the public markets will tell them that. If you believe that the outcomes are going to be small, we need to do two things differently. One is not put hundreds of millions of dollars in building these companies, because then no one will make good returns. And second, when you're making these companies with limited amount of capital, everyone starts behaving differently. I think the problem we've had is we've had too much capital coming into India, more than we deserve. And that puts pressure on the venture capital firms, because you have to put more and more money into the same company. Then the founders can demand higher valuations. Once the higher valuations come to the founders, they have to justify an artificially higher market. So the short answer to the question you asked earlier was yes, we did inflate the markets in our minds. Yeah. Founders did that, venture capitalists did that. And now we are all resetting it to say, hey, you know what, the markets may not be so large, the outcomes may not be so large. Therefore, let's start small, build small, and maybe the public market outcomes of the companies that went public at 10 billion, if they went public at 2 billion, all of us have been very happy here. So maybe that was the right path to take from the beginning. And I do hope that all the foreign money that came into India through the visitor funds, large amounts of capital that came in, slows down, and I think the Indian venture capital firms in general, those based in India with offices in India, have been very sensible. There was a little bit of push from outsiders and so on and so forth, for which we got carried away a little bit, but now everybody can focus, help companies, show them the right direction, reset our expectations to lower outcomes, and then it's all good.
Sure.
And I just want to add one point here. We tell our investors that when you invest in India, there are really two opportunities. One is you're investing behind the domestic consumption and companies that go after that. But equally important, maybe 50%, you're investing behind the innovation and products that are being built in India for the world. Today, India has perhaps one of the largest developer workforces, one of the largest semiconductor engineering workforces. The kinds of companies that we're investing at Peak 15 are really going after the global opportunity. And so I just want to bring that perspective in here. This is not just bounded, if you will, by our boundaries in terms of the companies that we'll be able to get access to.
Sure. So just as a corollary to the question I asked earlier is, all the companies that that got funded at late stage in boom time, let's say 2021, 2020, and all of that. Now we are in a different environment, the rates are up, there is tightening and all of that. Does that get resolved in private markets? Or does that create more, a higher hurdle rate for them when they come to public markets?
I think it's getting resolved, as you can see from yesterday's news of what happened with one particular company. I think many more will happen in the next few months.
How do you see that playing out?
So higher interest rates mean that, as an investor and I have choice, which means that if I have a return expectation of, say, 20%, on the other side, I can put money in an InvIT and REIT and get 10, 11%. So I know that money is safe. So what I need to then expect out of riskier capital, riskier business situations is going to be higher than what the previous bar was. So I think that's one reality that one will have to contend with, that there will be pools of capital which will allocate a little bit more to lesser risky stuff like this. So I think that's one thing that we need to contend with. But I just wanted to react on one of the points which was mentioned a little earlier. You talked about growth versus profitability. Now, I don't think it's a growth versus profitability debate. If it is profitability at the cost of growth, even public market investors are going to be unsure whether they want to participate in such companies, because a public market investor will say, okay, I'll put money in a REIT or an InvIT. I'm sure I'll get 10% return. So if this company is not growing at a rapid enough pace, then I don't need to invest in it. Right? So that's a situation that people will deal with. Another important statistics with all of us should really keep in mind. We all see the highs of some excellent companies going public and fantastic valuations in billions of dollars and so on. It'll be useful to see where is public money valuations concentrated at. The top 50 companies, which is the Nifty 50 potentially, solves for more than 50% of the market cap of the country. The top 500 companies solve for more than 95% of the market cap of the country, which effectively means that there are only 500 companies in India. There's only 500 companies in India where bulk of public money is concentrated on. So every new startup or every new early stage company or new business that gets into markets has to fight to get into that. And the bar is pretty high out there. So the bar, therefore, what it really means, it's not about disappointing people in this audience, but you got to get to public markets when you've got a lot of things correct in that period of time, whether you've got your business model correct, your return ratios correct, your scale is correct, and so on. Until that time, there has to be different sources of capital, and private markets is definitely a source of capital, which is willing to take that call. Some of the companies in the private markets will hit the public markets subsequently. Some of the companies in the private markets may not necessarily hit it, because they could potentially go and lie eventually as great targets for corporate India to buy into. And those could be the exit mechanisms. So I think as people who are investing in these businesses at early stages, you should be mindful of some of these points.
I'd just like to add one point on the growth and profitability debate. I mean, to me, at times, if there is a company that is about to go public or has gone public, and its rival or potential rival is still private, there's sometimes a conflict because the company which is already public or close to being public wants that profitability to show, whereas the private company might be willing to invest more in growth. So that becomes a bit of a negative, you can say, for the public company. So,
sure. So, Devina, you also brought up this point on governance. Again, Mohit, there is an expectation that, all these, even though I think Khosla or somebody else also spoke about this, founder friendliness, etc. It seems that even in terms of governance and the level of governance that public markets expect, the private markets seem to be falling far short of that. I mean, the operating environment, the ecosystem is not ready even at late stages to really go and face public markets. And like she pointed out that, when it is Sequoia investing, you do think that, a big name investor is here and therefore a certain level of governance is taken for granted. So what do you do as large investors to really bring in this, address this governance issue while you don't want to disturb system, you don't want to, you can only nudge the founders. How do you really deal with it, and how do you up the standards?
Super important issue. I think this is something that we need to just take on and do something about, rather than dance around the issue. So I'll make 2 points. First is 99% of founders out there are trying to build large, enduring companies the right way, and they are equally worried about getting sort of under this broad brush of governance being wrong. So they are actually demanding help. They're looking for capability building within themselves, and you need to find a stage appropriate level of governance. If you're a seed company, it's unlikely you're going to be able to attract the right independent board members to sit on your audit committee, for example. But as you raise money and as you get to Series B and C, you will be able to. So putting in place a playbook around a stage appropriate governance structure is critical in order for the companies to get better and better on this aspect as they grow. For that 1% that decides to cross the line, well, they should see jail time. Literally, it'll take strong action like that to deter people from doing things like that. So I think it's a combination of both things. And I was talking.
You're talking about 1%, but Mohit, when you have big names, I mean, we've had issues with Oyo, then Ola, then Byju's, and it's really not a joke, because these are really the poster boys. I mean, if you really look at the last 10 years, some of these companies were the poster boys, and if you have issues there, then I'm sure a lot of them are not in that bracket, but it does create a perception issue.
We was talking to Gayatri earlier today. I think governance, when we bring it up in a place, in a forum like this, it has a negative connotation as if there's something wrong. Actually, it's an opportunity. To me, governance is equal to reputation. And when you have a good reputation, you're able to actually hire better people. You're able to get better investors. You'll probably get better valued when you go public. And I think it's important for the entire ecosystem, all the founders, right, to understand that better governance equal to better reputation equal to better material outcomes, and certainly a better night's sleep. And so to me, it's not even negotiable. I mean, we will have to get better on this, whether it's a combination of better internal systems and policies, whether it's better capabilities on the board and within the companies. But I will just say to you that it's at least it's a topic of discussion now at every boardroom, rather than something that was not focused on. Sure. And so if I had to look at it as a silver lining, across the board, all VCs, all founders care about this issue and want to get it right.
Sure. So just one last question. What are the portfolio companies you're most excited about and you think will have the happiest experience thus far in public markets from your portfolio?
One thing I've learned is do not start projecting too much in the future, because it comes back to bite you. So this is true for going on social media and praising a company. This is about going and selling to another friendly fund of yours, saying, hey, this is a great company of mine, please invest here, or telling a public market investor, this
come on, you're just echoing what you are excited about.
You're excited about many things, but no, I would decline to answer this question, because many companies are doing a great job, but things change. We go through ups and downs, and we don't know who will have the best IPO. So I would...
He's ducking. Mohit?
No, I actually will also duck, but I'll give you a different perspective, which is...
I mean, 400 companies, come on, you can't name 4 companies.
Actually, that's my point.
That's not right.
Actually, that's my point.
That's not right.
Historically, the best returns have come from consumer internet companies. The next wave was a lot of our software and applications. Mama, it's a great company. Fintech companies, we talked about many of them on stage today. But what I wanted to use this opportunity to say is actually the opportunity set in India is changing very nicely, that many people may not be aware of. We made a couple of semiconductor investments. We made a space tech investment.
No, tell me about the IPOs that are due in the next 1 year that you're super excited about.
I don't know if there's a date of 1 year, but certainly I would say Mama Earth is preparing, folks like Oyo are putting up.
I hope it comes at a fraction of Nika valuations.
I think we over-index on this one word of valuations. We really should focus on some of the more important things beyond valuation, on governance and enduring companies being created.
That now we are taking for granted. Okay. What is the one private company that you would love to buy, and at what price? Let's say market cap.
I haven't really studied the private companies. I am a conservative investor. So I am, our mantra is risk management first. So let's see what comes, and then we'll evaluate and see.
In the public markets, Devina, tell me one stock and price that'll make it interesting for you? Nykaa at what price? Paytm at what price?
I have not
PB
done,
Fintech at
I
what
really
price?
have not done that exercise, but I mean, I just, since you mentioned Nykaa and some of these, I mean, what I find also, which was at the time all these IPOs came, that in many businesses, what really is the moat or the entry barrier is something you should think very deeply about when investing, that if it's a platform company or a D2C company, then ultimately it is money that is the barrier. And I'll give a very old example. This is a 20-year-old example. When Hindustan Lever was going into atta, and I had gone to spend a couple of days with Amul just to understand the consumer business, even though they were not, and they are not a listed company. And I said, what do you think of this entry into atta, and do you think it's a lucrative market? And they said, we don't think it's a lucrative market, which was our assessment also. But if Hindustan Lever proves it otherwise, we'll enter too. What's the problem? So that's the problem with proving a business model or creating a whole market segment that did not exist. That if the entry barrier is only really money, then someone else will also come in, which is why you should not project out to 2035.
Sure. Fair enough. Fair enough. Salil, one IPO that you're super excited about that's going to come in the next 1 year.
Because we are a hungry banker, so why just one? Yeah, we're happy that a lot of these guys, he's got 450 companies, Abhay has got a whole lot of them. We'll attempt to take every one of them
Okay, let me put it this way. So what is the one IPO that you yourself want to invest in?
I'm a banker. SEBI doesn't allow me to, so I'm not invested.
Okay, what you recommend to your parents?
Again, parents are dependents. I cannot allow them to invest.
All
SEBI is again
right, to your
proves.
best friends.
That's again insider trading, so again I won't get into that.
Well, Salil is a hard one to catch.
Okay, now I've run out. So this audience, he'll say, nobody should take my advice. Consult your own investment advisors. On that note, it was such a pleasure moderating this discussion. Thank you, gentlemen and Devina. Thank you.
A big round of applause for our panelists here. Thank you very much. Thank you.